Yeah, so what we're presenting today is part of Social Science Week, which we're very happy to be part of across Australia. It's a really wonderful thing that promotes our work and social sciences in general. In our session today, we're specifically presenting aspects of an ongoing program of research we've been doing over the past couple of years as part of our Newcastle Youth Studies Centre that's been funded mostly, if not all, by the college so far. And we're, obviously attempting to make the program bigger, and we've got some plans to kind of develop this in the future more and more. I suppose the reason we're interested in what we're doing is that financial practices tend to cut across a lot of sociological interests, right? Many of you are interested in just kind of things like class or gender and race and ethnicity, broad categories, but obviously then these inequalities pertain to those. The way that fintech is now increasingly becoming part of the suite of the platform capitalism that all people are engaging with in their day-to-day lives. There's just much here in terms of the way that the individual relates to the wider world and the way that we're immersed in various structures of power and the way that things like algorithms are increasingly becoming part of those things. So originally we were interested in young people and debt per se. And when we started to do some small exploratory studies, things like buy now, pay later and fintech came up in the research as kind of much more important things than we started off with in terms of we were interested in things like payday loans and how people are getting by. What we increasingly understand is that young people are stitching together a kind of way of life, a financial practice by not just the traditional, access to capital in terms of both educational capital and capital from careers and that kind of thing, but increasingly enrolling these kind of other opportunities and affordances into the way that they do things. So we're looking at this kind of fintech across multiple domains. You'll see stuff today where I'll be looking about buy now, pay later stuff. And Jonathan and Julia will be presenting the very first results of our stuff about bet with mates and gambling, which we all see part of this. Roger's looking at the way that housing is being enrolled in these things as well, and Bev's been doing work about the way that value is created across multiple platforms, particularly Facebook and more increasingly.
I've just had a few emails to say that people can't get in on Zoom.
Okay. But we also will be in the future hopefully looking at things like cryptocurrency, share trading apps, all these things that are just on phones. And I think most of us middle-class academics in the room will kind of think that maybe this is kind of middle-class privilege activity. But I play cricket with tradies that are using share trading apps daily. They've bought $50 worth of Bitcoin, and some of them still have like 12 grand of it left. Others got rid of it, right? So it's just opened up a bunch of opportunities, but it's also opened up a hell of a lot of risk. So one of the things with buy now, pay later in particular is that we know that you can have multiple versions of them, and they can actually then access a bunch of debt very quickly and get into trouble. So our work is kind of looking at aspects of that. We're particularly looking at kind of practices. We're not that interested in the kind of moral panicky aspects of young people's lives and how they're to blame and they should just make more rational choices. We don't really see young people as that. We see them as actually making quite rational choices in a world that kind of is exposing them to a bunch of risks. And with stuff like, rising costs of living and impossibilities of getting to the housing market, financial literacy in terms of rationality doesn't make a lot of sense when we now have figures from our own survey that shows that 38% of young people we surveyed have skipped meals in the last month because they can't afford it. So again, this very idea of kind of financial literacy here, we're kind of challenging to think about in a more kind of day-to-day realistic manner, and particularly how money is emotional, I suppose. So I'll hand back and move on. Yeah.
Okay, thanks. So Steve is up first. So Associate Professor Stephen Threadgold in Sociology at the University of Newcastle, Director of Newcastle Youth Studies Centre. You will be presenting. Do you want to lead up here?
Sure.
You're presenting the gamification of debt, gimmicks, and young people's ambivalent financialised subjectivities. So we've got just, about 20 minutes each presentation.
I won't take that.
Okay. I think we might have a little bit more time now, so I think we will do 1 or 2 questions at the end of each paper. So if people on the Zoom would like to put their question in the chat, I'll take some from the room and from Zoom. Thank you.
Okay, thanks. So what I'm going to talk about is I'm going to focus on the buy now, pay later apps in this presentation. But I would say that many of the things I'm talking about will apply across various aspects of fintech as well. I'm interested in this in terms of the way that financial practices feel in terms of the everyday life and the way that people are kind of doing it in everyday life. I was on the radio this morning and I was asked something like, what's changed over the past generations? And I'm like, well, in 1993, when I got an apprenticeship, I had to go to a bank and put on a suit to get an application for a loan to get a car to be able to do my apprenticeship. That's not really a thing anymore, right? People are stitching together this in various ways. So finances feel very different today. And they're part of everyday life. They're part of what we call the financialisation of everyday life and the consumption of credit. Credit now is not just something that accesses consumption. It's something that you have to consume yourself. There's so much of it. You have to kind of weigh your way through choices here to decide about what kind of credit you're going to have to consume. In the other stuff we've published already, we've kind of very obviously shown that young people and people in general have a moral hierarchy of debt. There's good and bad debts, but everyone's in debt. So HEX debt, for instance, is kind of seen as a semi-good debt. It's an investment in the future, despite the fact of how more extreme it's getting. Things like cars are ambivalent debts. You need them in a place like Newcastle where public transport's not great and you need to kind of get around to different parts of the city, but cars depreciate. Buy now, pay laters were kind of seen as kind of morally ambiguous debts in many ways. They were kind of seen as lower on the hierarchy, a little bit more instant gratification. But at the same time, our young people were using these things as well. So they're both critical and using these things. So there's a real ambivalence about this stuff. And as you'll see, that the young people we talk to are quite critical of them. So I'm thinking through this through Sienna Guy's work on gimmicks. She's a literary theorist who's written some amazing books about ugly feelings and about forms of aesthetics. And her latest work is on what she sees as a kind of meta-aesthetic in capitalism as the gimmick. You can all probably think of examples of them, Google glasses, Fire Festival, weird peelers that only peel an avocado or something, all these kind of different gimmicks that kind of attract us to kind of ease, attract us to the kind of the feeling of how something may be well designed and you want to kind of feel good and use that kind of stuff. But there's often an ambivalent or negative side of these things as well. So in terms of gimmicks, Nagai points out various aspects of them. The gimmick saves labour, but it also creates labour. So in terms of what we're looking at today, you don't need to go in the bank and put the suit on anymore to get the loan, but you still need to work to pay off the debt. You get notifications on the app that you have to react to. And everything you do on that app, you're actually working for the company because you're providing them data. There's also something that how the gimmick makes parts of capitalist production transparent. So, what it does highlight is that many people now just simply do not have the money to buy the things that capitalist production desires or what individuals want, but also makes something about capitalist production obscure. And I would say when we're relating to here is that thing that wage labour no longer really meets the financial demands of everyday life. The gimmick is a dynamic event. It kind of produces feelings. So when you buy something through buy now, pay later, you get that kind of reward and you might even get it later on when it appears in the mail. But it also is a static thing. The app's on your phone, it's not going anywhere, you can delete it, but the debt's always there, you're going to have to pay it off in some way or another. So Nagai, I think, is really useful for getting us to think about the way that much capitalist production, much capitalist consumption is also kind of recognised by the consumer as a bit of a grift, a trick. We often know what's going on in these spaces. They kind of haunt us a little bit. Something skewy going on with them all the time. They produce ambivalence and doubt, but you kind of have to use them anyway. So I'm just going to go through some of our data now. A lot of this is from a particular workshop we did at the end of this project, but there's also some other quotes throughout as well. So in terms of some of the first things I was saying there, it makes something about capitalist production transparent, but also something obscure. Many of our respondents didn't realise at first that buy now, pay later products like Afterpay and the like were forms of debt. They've been particularly good at insinuating themselves as at the point of purchase that kind of feel at first like PayPal, that you're kind of, and they do make you feel a little bit like you're using your own money, but you're not, you're going into debt. And as many others have shown, that the punishments for missing payments end up being about the same as interest payments on credit cards anyway. So you're going into debt, but as Hayley points out here, at first it felt safe. So you can see a lot of the quotes here, there's evocative feelings of emotions and stuff like that. Felt safe in my finances, could put it on Afterpay or ZipPay, you know, she already has two. Then I could pay it off and it would be fine. But now it's come to a crux where actually making me feel anxious. How am I going to afford the things that I need to afford? It's pretty frightening trying to wonder if I'm ever going to pay this stuff off. So she begins feeling comfortable, but then as she uses it after a while, the gimmick reveals something. The obscurity of the debt becomes transparent. Some of the apps aren't just for paying for stuff. Some of them kind of want to create their own kind of assemblage of like shop and experience and kind of entertainment. They also, some of them want you to pay for everything through these apps. So it's not just buying a pair of jeans or a record or whatever. They're encouraging you increasingly to pay your rent and your shopping through these things, to essentially go into forms of debt for day-to-day life. So we were talking about with our participants, particularly the ones that feel like shops and things like that, and you have the kind of cute bear here. There's lots of kind of cutesy language, and how the bear here, you can pause your payments, PAWS, and things like that. They kind of very much speak to some of the gamification things I'm going to talk about in a minute. But like, it's all about being in control, like own the way you pay and being happy because you have the stuff right now. And we're getting them to reflect here on the advertising. It's like they're selling you a lifestyle. Seems like you're debt-free when it's really deceiving. Hangs over your head, covering up the fact that you need to pay within 2 weeks. So you let your guard down a little bit. You can see here that Nathan then kind of even talks about this kind of cutesy nature that the guy talks about as part of the gimmick. So these places are just increasingly enrolling more and more financial practices in them, not necessarily just for buying stuff like for, you know, instant gratification shopping kind of stuff. This is a classic moment when you're doing an interview where you're like, there's a quote that's definitely going in a paper. Claudette started talking about these things as the Instagram of banks. It's like they're rising up to oppose banks just like Instagram did of Facebook. So there's a certain irony there that you know, banks are now getting into this space, and I wouldn't be surprised if they end up owning a bunch of them. But, you know, the kind of things that have come along that have disturbed this space are increasingly looking like traditional financial actors. It's literally imposing their entire world, surprising, I guess, a lot of people. It's a lot less transparent than it seems. So you can kind of note in a lot of these quotes, there's a kind of positivity, but then an ambivalence or even fear creeps in by the time we get to the end of them. So the buy now, pay later here kind of, it's straining to get our attention in all those kind of gimmicky, gamey ways, but you can kind of feel that something's not right when you're using them. They're not that transparent. On the outside, they seem easy, but then once you start using them, you can see the grift. In terms of the social media and the gamification aspects, the apps enroll a bunch of different aspects of all the other social media stuff that you probably know quite well into them in various ways. Some of them do some of them do them all. So they do stuff like send you reminders that you bought, you know, this pair of shoes last year. It kind of sparks some interest in maybe buying another pair. They send you like end of year Spotify wraps, not of the songs that you listen to, but of all the things you bought. And they're kind of constantly reaching out, straining to get your attention to try and keep you on there. So we know like this has been a long held thing where psychologists employed by, you know, poker machine vendors, the same kind of stuff is going on in this space. They're doing all they can to kind of keep you in the app. To, as Renee says there, remind you to buy more and Afterpay. What's interesting here is that if you do buy more, you get rewarded by being able to go into more debt. So if you pay off things on time, your $1,000 limit might rise to $1,500. So you're being rewarded to pay stuff early. Feels good now, but as Lillian says there, it's going to be an issue in 2 weeks' time. So playing this buy now, pay later game results in getting buy now, pay later rewards. It's not money though, you don't have to pay less. You've got to pay it back, and if you're not careful, you'll be in even more debt. So levelling up in these things, in terms of gamification here, very much feels like a levelling up. You get points as rewarded with more debt. They send me an email, a notification. This is Kylie. You've been a member of ZipPay for so long, you've paid everything off on time or whatever. 1,000, now you can spend 1,500 bucks. She didn't get the option to say no to that. It just increased, her level increased. So the shop component of the app as well, it's cool to go browsing. Top of the screen, 2,000 available to spend. It's big and bold up the top there. So we started thinking about what this means in terms of gamification, and it doesn't feel as much like a limit. These things feel like a challenge. You know, you've got $2,000 to spend, get busy. Feels like that kind of stuff in games where the heads-up display, you know, and your ammunition or stuff's going up and down, and you can be a bigger or better consumer depending on how much heads-up display you've got. So, as they also talk about here, it kind of makes things less transparent when it feels like a game. So it doesn't feel like the money actually exists. It's just on the screen. I thought it was a safer way to engage with a loan. It doesn't even feel like you technically have a loan. So the point system, as Chloe points out, encourages you to keep spending more and more. It really discourages saving money. And you can see here that our participants are actually kind of rehearsing many of the discourses about being financially literate, saving money, being careful, value systems. So as our workshop very quickly pointed out, debt is not a reward. Limits should not feel like challenges. And these are definitely things that we think should be considered when it comes to the regulation of these things. To sociologise the guy's gimmick rule about obscurity transparency, the gimmick is certainly a form of manipulation. It uses ads, gamification, psychological tricks to buy more stuff. But for our participants in these workshops and some of the interviews, they also created moments of kind of reflexive awareness. The manipulation doesn't always work. It's not critical engagement's provoked. And from a youth studies perspective, we think that's, well, at least I do, think it's very, should speak for everyone. But I think everyone agrees in the centre that like the kind of constant position of young people as cultural dupes and, you know, the stupid avocado eating, you know, not loyal, you know, irresponsible stuff makes no sense in this realm. We know that young people are actually critically minded and more often not actually act reasonably in these situations. The last example is another feature that comes in that's kind of brought in from Uber, that you can send a thing to one of your friends to say, come and join this app, and then you get $10 to spend. That kind of thing that happens to try and get people more and more on the app. It's kind of a loss leader. So, you know, our participants particularly hated that aspect. We're not someone to invite someone, I think, by using that. If someone invites you, they're a bad friend. Our participants essentially resent the financialisation of friendship that's going on in those situations. So Chloe and Claudette do not want this free money, going against those kind of notions of homo economicus that dominate economics. They resent the gamified financialisation of friendship. This all kind of troubles the homo ludens aspect that's being brought in to think about the way people work through nudge economics and the likes. This nudging doesn't always work and actually kind of often produces opposite effects of what the nudges are meant to engender. So to kind of sum up, I'm kind of currently drafting up a paper that relates to Ngai's earlier work on ugly feelings, and I'm calling it in-debt pending. Ngai wrote some really interesting new feelings. I think one was called stup-limity, about the feeling of being stupefied and limited in various aspects with the online world. So in-debt pending kind of talks about the subjectivity of young people and their financial subjectivity of being in debt and the way that affects their attitudes towards the future and their sense of being and feeling in the world. So they're in debt as part of in-debt pending. Their independence is sometimes, it's prolonged to be able to achieve that in terms of their own financial positions, their levels of debt, their relationship to their parents, and the pending. We know that from our work with young people, where we were talking specifically about with them that had lots of debt, that when they're in that situation, the future seems a long way away. It's always pending. The very idea of being an adult seems to be pending if you're in a position of not being able to be financially independent. Financial independence too is something else I think we need to reconsider, because pardon me, I'm losing my voice, is that increasingly we're seeing in our research that not many young people, and even into 30s, are completely financially independent of their parents. And as Julia Cook's work really shows, getting into the housing market today, up to 60% now of first-home buyers are getting help from their parents. 10 or 15 years ago, it was only 10 or 13%. So these are kind of ways, I suppose, to think about not just the way that the debt affects the way someone feels in the here and now, but how it can kind of produce a sense of a future or a kind of future foreclosed, largely dependent on those kind of financial subjectivities. Thanks, I'll leave it there.
Okay, so we've got time for a couple of questions. Don't have any on the chat yet, so it's open to people in the room. Okay, thanks. I'll have to give you the mic.
Thanks, Steve. That's really interesting. I just wanted to know a little bit more about your participants in the workshop. Who are they? Where are they coming from? How much debt are they carrying? Like, who are these people?
Yep, I'll get that back on. Sorry. Okay, so now we've done so many small projects, I need to kind of remember the details of what that one was. I'm pretty sure that the participants in that project were creative industry students. So we did a small project last year talking to creative industry workers and students about their use of what we were calling entrepreneurial debt, where we were interested in to see if they were going into using these things to buy to support their Adobe subscription. That's a ridiculous amount of money for someone that's studying full time or whatever. So that was part of that. Again, we've got another paper drafting up at the moment that, well, what's really interesting is we're finding with those students, for instance, is they're experiencing many aspects of being in the creative industries as forms of debt. Things like subscriptions, things like having to have, the brand new material. But what we're also finding is the way that they're supporting each other. So we're finding lots of aspects of commenting where they're like, they'll do a project together and one person will have the film gear, the other one have the sound gear. And what's also interesting too about that is they know that they're subsidising companies that they're working for that don't have those things. So there's this real interesting kind of precarity that goes on while at the same time they're supportive of each other to try and get stuff done. And then after working for a full day, they come home and they get $50 each. So it's like a real interesting mix here of the very obvious problems that's happening across the youth labour market, I suppose. But the people we spoke to in that workshop in particular that dominated that one were largely, I would say, relatively middle-class kids that had a bit of support. They weren't particularly privileged. They were very much the middle. Yeah.
Thanks, Penny.
Thanks, Steve. That was really interesting. I was just thinking about this idea about good debt. You kind of talked about HECS being good debt. And as they were students, I just wondered if you had explored the questions around student debt.
Yep.
And, there's all sorts of discourses going on around, this notion of being debt averse and the coaxing into debt that we're seeing as higher education has become marketized. So yeah, just any reflections on that?
No worries. Yeah, so there's quite a lot in the Creative Industries Project about HECS. They're not convinced that it's going to pay off. There's almost, and I don't know whether I'm being influenced by the current study we're doing, but there's like a gambling orientation towards a lot of these things. And they talk about it in terms of investment and return. And we have a bunch of quotes in our creative industry stuff about at the moment. Some of them like third-year students, but they're kind of doing a little bit of stuff on the side and they've got a lot of side hustles going on as well. That they just can't possibly see how this degree is going to pay off. I mean, $60,000 worth of debt. So we have one in particular really evocative quote that's like saying the amount of money that we pay for these courses should be in big bold letters in the guides. Of course, we don't know what's going on until it's too late, or we feel like we're being impelled to do this over others. So it's definitely something that universities are going to have to reckon with, for sure. Yeah. I don't know if that directly answers your question or not, but
Oh, it
yeah.
does, yeah,
Thanks.
thanks.
Okay, thanks. So, thanks, Steve.
Thank you.
So we'll move on to our next presenter, which is Professor Roger Burrows. You're next, I think?
Am I next? Oh, well, that's a surprise.
Sorry, and Ron.
Okay. Oh, well.
So, Roger is a professor of global inequalities at the University of Bristol in the UK, and he's also an honorary professor at the Centre for Cities at the University of Melbourne, which enables him to be in the country and here with us in the room today. And the presentation is called Digital Risk Profiling Technologies as Housing Market Intermediaries. Thank you. Yes.
Okay, thank you. Sorry, I thought I was going third, so that's why I was quite surprised. So I'm going to talk quite speculatively, I think, about a Nuffield funded project in the UK that I'm carrying out with my colleagues here, Alice Mollis, Dave Beer and others. And we haven't produced too many outputs from the project so far, but there is a literature review if any of you find this interesting and want to follow it through. We've always been interested in sort of housing policy, and some of us have been interested in the impact of digital cultures, and this is a great opportunity to bring those two things together in ways that I hope you find interesting. Last time I was in Australia, and I must say I try and spend as much time as I can in Australia at the moment. If any of you have been to the UK recently, you'll know why. Is that when we arrived, there was kind of a bit of a moral panic about data leaks. I don't know if you remember this. There was a whole series of stories about renters suddenly discovering that all sorts of data had been leaked from their applications. And in a sense, this was a kind of a surface indication of something that's going on more broadly, which is the way in which new digital technologies across tenures, not just in the rented sector, but in owner occupation and in public and social housing as well, is increasingly coming across rather more traditional systems of kind of credit scoring and risk assessment. That new digital technologies and new techniques of predictive analytics are kind of crunching against those systems. And probably emblematic of that technology, in Australia at least, is this website, this app called Snug. Has anyone come across Snug? Snug, you've got to think about, and again, I don't know about the real estate market in Newcastle, but I don't imagine it's quite as desperate as it is in Melbourne and Sydney, where you can have 50 or 60 people go for the same rental. So Snug allows you as a potential tenant to build up a profile. And the more data that you give about yourself, the higher your Snug score goes. And it's not data that you would routinely give up. It's data about perhaps what your parents' occupation is, what the name of your dog is. Perhaps even you might give access, and I'll talk about this later on, to your bank account through a system called open banking, which has just been introduced in Australia. We've had it for a long while in the UK. You might even want to give them your Spotify profile, because there might well be some kind of predictive analytic association between the music that you listen to and the risk that you're going to thrash the place or go into arrears. They got into trouble because one of the other things that they asked for was whether you were willing to almost like tip. Today, when we're paying for our food, you could pay a 5 or a 10 or a 25% tip. Well, you can now also say whether you're prepared to pay, 5, 10, 15, 20% above the rental ask in these urban centres. So again, surface manifestation of something that's going on more deeply. So I'm sort of a sociologist, I suppose, but I often read lots of geography, and one of the books that's most profoundly affected us recently is by the geographer Louise Amoore in her book Cloud Ethics, which is looking at the role of algorithms in everyday life. And one of the notions that she comes up with that we've been using in this project is the idea of what she calls regimes of recognition. The idea that increasingly the kind of digital data that we give up allows us to form a kind of a digital doppelganger, I suppose, that wasn't always apparent to other kind of risk assessors in the past. So as we provide more and more data, we provide more and more kind of a sense of who we are, and we're recognised as such that it's no longer an evaluation of us in a as William Gibson might call it, a meat space as a person that you are, but you're orientated increasingly to the kind of way in which you are labelled, categorised and assigned. And really we can see that within housing markets. What I'm going to argue is that the way in which we assess risk is becoming increasingly differentiated, and increasingly we live in a world where the notion of a kind of what Deleuze might call a individual or a market segment, I suppose, a cluster, based upon all of the data that we give up, is the way in which we're characterised, and we're orientated, we're recognised, not as who we are, but what the algorithm generates about us in terms of a series of different ways in which we're assigned. Steve sent me this paper a while back from Theory and Society, the person of the category, pricing of risk and the politics of classification, insurance and credit. And it's been a key paper for us to think about the way in which risk has changed in relation to housing markets. Essentially, it's a historical pre-digital paper which looks at the different ways in which risk is assessed in things that we're very familiar with. So within the insurance industry, for instance, our risk at the moment is broadly assessed in terms of our membership of a different group, real people, based upon, they can't use gender, but they can use proxies for gender, but based upon other attributes that we might have in terms of a probability that we're within a particular group that's pooled as such. And that's a very different way of assessing risk and pricing risk compared to more attribute-based systems which have come to the fore in terms of credit referencing. Credit referencing scores, your ability to access loans and mortgages and to access different differential rates, is really based upon a series of attributes which are added together. They're not pooled probabilities, they're based upon a whole series of different attributes. So you can have the same credit score as someone else, but the way in which you got that credit score can be based upon a different combination of attributes. Is that clear? Now, they're the kind of the dominant ways in which risk is assessed. And you might have access, for instance, to your credit score through companies like Experian or Equifax. You can get a little app now and see what your credit score is. And that becomes increasingly important in terms of your access to all sorts of goods and services, including increasingly your ability to access the housing market, mortgages and rentals. But something's been happening, which is to do with the digital turn, to do with big data, and unfortunately, I'm afraid, increasingly to do with machine learning and AI, which is the ability to take all sorts of data, any sort of data, in fact, that can be attached to you as an individual, including data of other individuals within your network, and to calculate a risk score, not based upon you, but based upon a kind of a compound of you, based upon all of this data. It's what some writers have called the phonetic urge, the idea to use any data that you can get hold of, put it into a big statistical pot, swill it around, apply a statistical algorithm to it, and to produce a series of mutually exclusive and exhaustive categorizations of people, which can then be used to base a whole series of different predictions on. Now, we've written a book about this called The Predictive Postcode, because hitherto, most of this kind of analysis has been based upon where you live. And all the data about you has been associated with your address. So whether you know it or not, whoever you think you are, many companies and organisations are orientating to you not as who you are, but who they think you are, based upon a cluster analysis of your attributes and your histories, your credit history, your working practices, your employment, and increasingly your consumption preferences and tastes. And every address in the UK, every address in Australia will have a classification, a socio-cultural characteristic, which will be able to predict how you're going to vote, what you're going to buy, and a whole manner of other things. And this is a tradition that comes out not of the insurance industry, not out of the credit referencing industry, but out of the marketing industry. And an alternative title for this paper is going to be your clusterfuck, because it's basically about the application of clusters and clustering orientations to data to characterise people in different sorts of ways. Now, I won't go through the history of it, but there's a book called The Predictive Postcode that goes through the historical development of this kind of way of thinking about risk that begins with census data, that then begins to combine census data with digital bike data, and now is using data from social media. So all of the data that you leave as a trace is now worth something because it characterises a more and more nuanced sense of various kind of risk profiles associated with you, including, as we'll see in a moment, access to housing markets. There's an interesting history, which I won't go into now, sort of a history of a shadow social science, because you can trace this tradition right the way back to Booth's classic studies of London and the classification of different sorts of poverty, through the Chicago School, through the introduction of various statistical techniques like factorial analysis and cluster analysis, and then the emergence, first in the academy, of a system of classification called geodemographics, which kind of escapes in the academy because it makes money for organisations, and it's used to make all sorts of marketing decisions. But the world is changing, and now it's no longer where you live where the big money is. It's now where you go where the big money is. And the new kid on the block is not geodemographics, but geolocative geodemographics, and based upon an analysis of where you go with this thing. They don't even need to know where you live because it's going to be relatively stable or in the same place for 8 hours most evenings. The application of cluster analysis based upon not where you live, but where you go becomes increasingly nuanced in terms of forming kind of clustered segments, characterizations of where you are. This is the current geodemographic classification of everyone in Australia, for instance. So you will be in there somewhere, and there will be a whole series of risk probabilities associated with each of those different one of the 51 different types. But this is the geolocative technology, mobile phone data, which increasingly, of course, doesn't just track where you are in a city or where you're moving to, but also possesses essentially a codification of your habitus, your musical tastes, your reading tastes, your newspaper tastes, a whole series of things on your phone, which themselves can be clustered and then tracked and traced around the city, such that we're also, at the same time as being tracked ourselves, mapping out the city for analysts then to make decisions about location decisions based upon where people go with certain characteristics. So I'll go through all that very, very quickly, and essentially say that this is where we are. We're in a situation where increasingly human populations are not just trackable, but we can track the kind of mobile habitus within the phone. So social media segments become geolocated. They're out there in the real world. They're not just sitting any longer on a PC. But all of the activity that you engage in digitally is then mobilized and tracked and traced and recursively used to classify a risk assessment of you as a particular segment or a cluster. And then predictive analytics identifies strong correlations with potential default or other attributes that we might be interested in relation to the housing market, but with little or indeed no theoretical rationale for why they work. And for those of you who have ever read Thomas Pynchon's novel Gravity's Rainbow, is there for that very particular reason. It's a strange book, but essentially it's a novel about the doodlebug, the flying bomb in London in the Second World War, and a statistician called Roger, as it turns out, who's charged to try and understand if there's any analytic pattern in where the doodlebugs are landing, whether it's to do with the weather or the temperature or the wind or whatever. And they can find no correlation between where these doodlebugs are falling across the city until he discovers that they're falling within quarter of a mile of places in London where he's committed adultery. And then the issue is, in terms of predictive analytics, whether he should try and commit adultery again to see whether the doodlebug falls within that particular spot. But it's the same principle, predictive analytics. No theoretical reason for why listening to a particular sort of music, having a particular sort of history, living in a certain kind of area of the town should lead to particular sorts of outcomes. So housing is what we're interested in, and just going to look at some of the kind of early prefigurative things that are happening in relation to the segmentation, the clustering of these new regimes of recognition in algorithmic risk profiling in housing. Hitherto, it's been old school banks. Hitherto, it's been credit referencing. It's been to do with the history of your ability to pay off debt. It's been financial data. It's been credit scores. And those things are still there, but they're crushing up against this shift away from traditional individual measures. These existing schemas that we're familiar with are being supplemented and possibly superseded by big data systems with their origins, as I've tried to describe, in marketing. So we're moving away from actuarial risk, from insurance-based risk, from credit referencing risk towards these clustered systems. We're seeing new ordinal registers based upon the combining of various segments of risk data, new forms of what one might just call rated agency, using synthetic measures that themselves are constructed from multiple variables. The legal status of such variables is interesting. You don't need data on ethnicity, you don't need data on gender, because there's very good proxies for those things within the data. So we have geodemographics based upon where you live. We now have geolocation segments, you are where you go. We have data just on your name, address, and mobile number that will allow you to be classified into quite nuanced combinations of attributes. Okay. We have social media and streaming feeds. We have segments and clusters that define a particular habitus that can be monitored over space. As I said, even your musical tastes might be predictive of future mortgage default. And there's more. I just want to look at the more, some of which to do with what we're doing in this room here now in a university. In the UK, we now have data that the Institute for Fiscal Studies has analysed, for instance, which has income data on every degree programme from every university in the country. So it's not just that you've done a degree in sociology or that you've been to the University of Newcastle, it's that they have data, they don't here yet, I don't think, but we do in the UK, what your likely future earnings are if you've done a particular degree within a particular place. Hence in the UK, all of the concerns about students not paying off their debt and a forced closure of some combinations of institution and degree where that doesn't happen. Well, that data becomes very, very interesting to potential lenders and rental agencies because if you have, for instance, done sports science at the University of Exeter and you're female, you're a pretty good bet in terms of what your future salary is going to be. But if you've done exactly the same degree at the University of Lincoln, they're not going to touch you with the barge pole because your future income, not your income, of course, the income of others, it feeds into the algorithm as one example of the sort of data that's being collected. But also no longer just analysing you as an individual as the container of risk. You're in a network. And increasingly, the formalisation of what we've been talking about earlier on, and we'll hear more about later on, I guess, which is to do with the role of the bank of mum and dad and the bank of grandma and grandpa and the bank of brothers and sisters. That data also becomes important as well. You can have two people with exactly the same individual characteristics, but with a very different network, and their risk assessment will change. So this is, to use the language of Lisa Atkins in the asset economy, the kind of extended notion of what she calls the Minskian household. And it's the household that becomes the unit of assessment. It's like the formalization of what's already happening in terms of the use of money within families to kind of strategically pay for education, to strategically pay for housing deposits, and so on. And Julia, who's in the room, has just done a great paper in Australian Feminist Studies about how this works on the ground and how I believe it will increasingly be codified within these systems. Okay, coming to the end. You have it now. I don't think many people are aware of it, but it's been in the UK for a good 4 or 5 years as a new thing called open banking. Anyone come across the notion of open banking? For those of you who bank with a number of Australian banks, you might already have seen some little symbols appearing against your expenditure. You know, some knives and forks, a pokey machine, a whole range of different things in relation to what you're doing. It's meant to be, initially, for you to analyse your expenditure and take control over what you're spending your money on. And you can do that. But it's open banking, which means that you can also tick a box or sign for a third party to look at your current account. And companies like Experian and other credit referencing agencies will offer you something called a credit boost, which means that you might have a low income, but if you're spending your money wisely and they can see that you're spending your money wisely, they'll increase your credit score or decrease your credit score, which will give you differential access. So in a sense, very, very mundane activities now begin to feed into a kind of a constant calibration, a constant measure, a constant segmentation of you in terms of a risk profile. So some good things that come out of this. Maybe all of that history for private renters of having to get references and give all your data up changes. It all becomes codified, maybe even blockchain within a card, so that you have a kind of a record that you have been spending money on rent, which is as much as you're going to be paying on a mortgage. It could actually kind of feed into these systems, but it's a major change. Happens within the social rented sector as well. The tenant passport scheme shows that you're a good tenant, that you've paid your money, you get a particular score. If you want to change house and so on, you can see how it all works. And back to Snug. Here you are updating your rental reputation. If you upload your address history, your employment details, your income, more identity documents, background check documents, other documents, personal references and so on, your score goes up. More and more data, and hence the data breach. That just allows you to view a rental, and after that you may be able even to access the rental. It's a kind of a machinic codification of these sorts of processes that really doesn't look a lot different to the Chinese system of social credit, if one is going to be honest, in terms of all of this data from all of these sources, all being brought to bear upon various sorts of risk assessments. And probably the best analysis of this is Black Mirror. Thank you very much.
Thanks, Roger. Any questions from the room?
I suppose my question is pretty simple. So what? So what if there's categorization? So what if it has its cluster analysis? Ultimately, that is data that helps a business make a decision, right? Who cares?
Well,
Hang on.
Who cares? I think in terms of our traditional understandings of how credit scoring works, most people know how it works, I suppose. You know, you used to tell kids, get a credit card, use it, pay it off each month. You can build up your credit score by doing sensible things, and this is how you're going to access a kind of a credit history. So we kind of knew what we needed to do. Whereas under this scheme, although it's a system of classification, recursive real-time classification, we don't really know what it is that we're doing that will actually have an impact upon our future credit score. We don't know what will tip us into a particular mutually exclusive, exhaustive set of clusters, which will have a particular risk associated with it based upon a series of attributes, a series of kind of activities completely away from whatever it is that we might be interested in. So I suppose what I would be worried about is the way in which we're being kind of metricized as humans, that all of our activities are kind of recursively folded back in, and we might not even be aware of it. We're not aware, most people aren't aware of their kind of geodemographic classifications, which nevertheless have an impact upon their ability to access credit and such like. So I suppose you care when it's not just a classification for the purposes of analytics, it becomes ontologically real, and it actually makes money for business. That's the kind of the thing that underpins what works, I suppose, in terms of the generation of these clusters. But I think it has consequences for how we function as a society. You know, hence the kind of the Black Mirrors kind of metaphor, I suppose, whereas you don't know what it is that you are doing that is actually going to lead to the final kind of outcome. So I suppose my concern would be to be open about it, to be explicit about it, and maybe have some kind of systems of regulation so that we can see how the classifications change. Otherwise, we might engage in activities, including, I should say, overusing, if that's such a thing, the buy now, pay later scheme, because we don't know what the consequence of using that will be in terms of classification later down the line. We might buy a particular car and pay a particular kind of level of insurance for it, but we don't know what the consequences of that are for how we're classified for other kind of outcomes. So that would be why I would be concerned. So openness to those kind of classificatory regimes, I think, quite important.
Thanks. I've got a couple of questions in the chat. I'll just choose one, and you've got one later, but we'll come back to the other ones. So Monique asks, how might the growing awareness of clustered categorisation influence one's emotions towards debt and credit, such as what Steve talked about in the previous presentation?
Well, I think it's quite interesting, really, how when you're made aware of your classifications, let me just look at the Australian classification. I think there's sort of disjuncture between the meat space about who you think you are and how you regard yourself. When you're actually confronted with kind of a marketing classification, some of which are kind of quite crude. You know, I might not think of myself as secure tranquility. I might think of myself as someone who's, you know, slightly younger and funkier than I actually am. But the knowledge that actually you're not being orientated towards yourself or your perception of yourself, but you're being orientated to a kind of a digital doppelganger or an algorithm that has a particular classification on it is you know, emotionally kind of tiring at best, I would thought. So, you know, I don't want to overstate it, but I maybe 10 years ago, I think we came to the conclusion, and I think we were correct, that I think we haven't kind of articulated as such, but one of the biggest kind of struggles we constantly have is between our sense of self and the way in which our bodies, our actions are ascribed by external agencies. And that kind of mismatch, I guess, can be emotionally and bodily, you know, harmful, I suppose. So it's this whole idea, I suppose, that who you think you are and what you want to do is at the same time kind of mirrored by a set of kind of classificatory regimes based upon clusters that we don't really understand and techniques, which nevertheless are characterising us. And not just characterising us and not just describing us, they're setting up real constraints and feeding into algorithms, more and more data going in, which actually change your life chances and those around you, and even affect the way in which the built environment is structured in terms of the decisions that people who use this technology use to make decisions about the built environment.
Thank you, Roger. Now invite our next presenters up. So Jonathan Curtis and Julia Cook are presenting the next paper on behalf of the broader team, Steve and I. So do you have to move the presentation up while I introduce you? So Jonathan Curtis, Dr. Jonathan Curtis is a casual academic and research assistant in the School of Humanities, Creative Industries and Social Sciences. And Dr. Julia Cook is a senior lecturer in the same school. And the presentation is called Betting with Mates, Gambling Apps and Young Men's Social Practices.
Thank you. So as Julia mentioned, this is kind of the latest in our program of research on young people and debt, and emerged, I think, quite naturally from the type of work that Steve was talking about. And this is very much also a work in progress. So we're presenting on it for the very first time today. We're still in the midst of data collection. So we're intending to kind of share with you some initial kind of thoughts and reflections. So we're very open to feedback, particularly helpful since we're still right in the thick of everything. So in terms of our particular topic, why young men and why sports betting? It's really framed in the context of recent developments in gambling in Australia. So just to start off at the really kind of big level, we know in Australia we are the biggest kind of gambling losers of money per capita in the world, which is, I think, not a particularly title we should be particularly proud of. And here in New South Wales, I believe that we're the gambling capital of Australia. So we're really doing this research right in the kind of epicenter of things. And so in the Australian context, some research looking from the 90s to the 2010s has found that sports betting's emerged as a pretty kind of significant source of gambling-related harm, particularly for young men. And then over the period from the 90s to 2010s, it was the only kind of form of gambling for which participation rates have increased. So it's one of the only kind of growing forms of gambling in the Australian context. And then prior to the pandemic, some research in Victoria found that young men's engagement with sports betting, that around about a quarter of them had started sports betting before they were 18, and that there was a really strong relationship between kind of betting and consumption of alcohol, and that they had many different accounts across betting kind of platforms, apps, services. And then in 2020, we kind of come to the pandemic context. Young men were found to be the subpopulation that were the most likely to be signing up for new gambling-related accounts, and they also, even those that were already engaged at that point, increased their frequency, increased their spending on gambling. So that's kind of the wider background context to why we're looking at this, why we think it's interesting, why young men, why sports betting. And then we come to the focus on sociality, in particular on bet with mates. So previous research has found that friendships have a really significant impact on young men's sports betting behaviour, that is often through kind of peer groups that they're getting into this in the first place, and friendship has an impact on who is engaging in sports betting, what kind of frequency. So we know there's something interesting going on. We were particularly interested in the bet with mates functionality on the very popular Sportsbet app. So this function basically allows people to pool their money and create a kind of digital app-based betting syndicate and put bets using the collective funds. And as Jonathan's going to say, as we get to some of the data, the Bet with Mates app was really not that much of a significant feature. The kind of betting as a group, very much so, but the app not so much, which is a really interesting finding from this work. And so basically our project looking at gambling as a social practice and trying to understand, for these young men who are engaging in sports betting with their friends, what kind of practices are associated with gambling? What is the role of kind of social practices, sociality in their engagement in gambling? So our participants have been recruited through local sports clubs, cricketing clubs in particular. We've analysed 9 interviews so far. They're very much ongoing. Our age range is 18 to 30, but so far everyone's been 23 to 30. Most of them grew up in Newcastle, currently living in Newcastle, and all of them are straight, white, and identify as men. So we're talking about quite a specifically, I suppose, contextually located sample here. So I think a lot of the points we're making are points that can be made around kind of, white Australian masculinities. And there was a range of education, and all of these participants hold regular jobs, most of them in full-time ongoing positions, range of different kind of income, but generally relatively financially stable. And in terms of their kind of contextual financial practices, most of them didn't really do any formal budgeting and tended to, I suppose, not have the kind of spreadsheets or anything like that, and just kind of monitor their finances in a more kind of ad hoc way. Mostly they didn't use credit cards, which tracks with what we found in our other research, in which young people are increasingly unlikely to use credit cards. Car loans and HEX debts were mostly the types of debts that they held, and they did not particularly use buy now, pay later services. We would think that that's because these services have a primarily female user base, and they're quite kind of feminine coded in many ways and in much of their advertising. And many of them have kind of shared savings accounts with their partners, so they're kind of saving towards goals, combined finances. Some of them owned homes, most of them lived out of home. Most didn't really have investments like share portfolios, cryptocurrency, that sort of thing. And the income range was quite broad. So I'm going to hand over to Jonathan, who's actually been doing the interviews, to share some of what we're finding so far.
Thank you, Julia. So as Julia explained, we're sort of going to be running through some of these initial themes that we've brought out from those 9 initial interviews. So in line with those comments that Julia just made about the sort of financial practices of the participants, most of them describe themselves as being good with money. And so generally that is coming out to mean one of 2 things. First of all, they're regularly making deposits to those savings accounts that they sometimes hold with their partners. But secondly, it's also an indication that they are able to live their lives in the way that they want to. So with that broad range of incomes that we've seen across the participants, those sorts of perspectives on what it is to be good with money tend to remain pretty consistent. So whether or not it's someone who's earning $40,000 or $50,000 or who's earning $150,000, that idea that they're able to use the money in the way that they want to use it makes them good with money as such. And so, as you can see from this data from one of the interviews, Greg's suggesting that he's not great with money, but he's not bad either. And he's able to make those sorts of deposits to his savings account, except when other things that he wants to do get in the way of that, like going out on the piss, as he says. So there's that perception, despite not necessarily keeping a budget in a formal way or anything like that, that these young men are able to be in control of their finances to a certain degree. So with that in mind, when it comes to their gambling preferences, they're quite consistent, but also quite varied as well. But it's been interesting to note that when asked about what they like to gamble on, the first comment that is always made is to do with the type of sports betting that's facilitated in the apps that we've been sort of interested in. So as Lachlan says here, when he's asked, pretty much all I bet on is just 3 things. Footy, so when we're talking about footy in this context, it's generally the NRL, so the rugby league, horse racing and greyhounds. So, but then when I ask if he ever plays the pokies, there's a recognition that yes, I do actually, and that's also gambling. And similarly, questions about casinos, lottery and these sorts of things. But I would also note that in this sort of discussion, when we're talking about the participants being involved in these other forms of gambling, like playing poker machines and visiting casinos and this sort of stuff, a lot of that is happening in a context that's heavily associated with the sports betting as well. So when the participants are playing pokies, it might be the end of a Saturday night out with their mates from the sports club, where they've spent the earlier part of the evening having beers and placing bets on an NRL game that might be taking place. And then as the night progresses, they find themselves in the pokies room playing the pokies. Or when they go to a casino, it might be on an end of season boys trip with, again, mates from their sports club that's been perhaps facilitated by a punters club that they're involved in within that sports club that then pays for the end of season trip and these sorts of things. So again, we're not 100% sure where this is going to go yet, but definitely something that we're interested in exploring further. It's also the case that there's a big differentiation between how the participants are understanding their practices when they're doing it in a group and when they're doing it alone. There's an unspoken sort of negative connotation to gambling alone, and it's definitely been the case that the participants who have voiced the sort of examples of having particularly negative experiences often are talking about times when they've found themselves gambling on their own rather than in that social setting in a pub with friends, as Tim's explaining in that quote at the bottom of the page here. So it's a important distinction that we're sort of looking into exploring further and understanding how that differentiation that's being made by the participants is actually influencing what they're experiencing in the sort of sociality of the gambling practices. So in the context of the fintech side of things, it's quite clear that like the sort of weekly budgeting that the participants do, it's a very ad hoc process that they're following in terms of managing the money that they're spending on gambling. So it's often the case that participants will deposit, say, $50 or $100 on a Saturday night that they know that they're going to spend on their gambling account. And then the outcome of that money, win or lose, will basically be to use it until it's run out. Or if it's a significant win of more than a couple of $100, perhaps they might withdraw that. But as the second quote there shows, it might be the case that they know they're going to spend that money on gambling in a week's time anyway, so they'll leave the money in there and not withdraw it. But there tends not to be much attention paid to sort of the statements that the participants get sent every month about their spending and how much they're winning and how much they're losing. It's more sort of, I've got $100 in my account so I can make 5 bets tonight. And if there's nothing left, there's nothing left. If I win $200, that's great. But it's a very sort of, ad hoc approach to it. So the majority of this sports betting is taking place through gambling apps on smartphones. So there's a range of different betting agencies that offer these services. And most of the participants have accounts with more than one agency. And they tend to be open to take advantage of promotional offers that are particularly appealing on any given day. It might be really good odds for a sport that they're interested in or something like that, but that doesn't necessarily mean that they're likely to go back to that app after that promo has been used up. And it's quite clear that there are a couple of apps and betting agencies that are most popular amongst the participants. And as Julia was sort of talking about before, the feature Bet with Mates that we were quite interested in with starting the project, whereby on these gambling apps you can create groups where the participants in the groups pool their money together and can place group bets through the app in quite a sort of structured way. But it's become apparent that most of the participants aren't particularly interested in that feature of these apps. And as this quote is suggesting here, it's something that they're doing without that Bet with Mates feature, and there are others from different agencies. They're already doing those things. And so it appears that that feature isn't really adding anything to the sociality of the experience. They're still able to place a bet with their friends and have those experiences of sharing in a win or sort of commiserating with each other during a loss. Without having that infrastructure offered by the app and the platforms in that sort of way. So that's been something that has been quite sort of surprising and interesting to us in terms of the way and the gamification of how these young people are playing these apps. One of the interesting parts of the sociality of it that has emerged was several of the participants who were involved in during COVID lockdowns were involved in regular Zoom sessions where they used Bet with Mates to maintain the sort of social gambling practices that they would have otherwise. So if you will, it was a virtual pub where they'd get together on Zoom on a Saturday afternoon and sit around talking about sport, drinking beer and placing bets with Bet with Mates, just as they would have done in a pub. And so that's been consistent across a group that has sort of been doing that. And it's been interesting to see that them talk about that it wouldn't have necessarily been contingent on the betting, but it was a big part of it. It was a way for them to be able to talk about things and get that conversation happening. And particularly in the context of masculinity and sort of how normalised these practices are for young men. That's another interesting node that we're keen to explore further. So the way these young people are gambling is often seen as something that's been normalised throughout their lives. So often they'll speak about being exposed, not in any sort of major or traumatic way to gambling as a child, but going to the pub with their grandparents and playing Keno, being asked to pick some numbers by their grandmother when they were a young child and these sorts of things. And growing up in a setting where that gambling was happening, and also particularly normalised around sport. So all of the participants talk about the way that they got into gambling because they were interested in sport. It was something that was part of sort of growing up and continuing to be involved in, whether it's playing or being a member of a club or whatever it happens to be, but actually sort of a natural extension of that sort of culture. But it's also quite important to note that most of the participants identified times when they'll go out to these same sorts of venues, but not necessarily bet. So they might go to dinner again with a family or a partner and these sorts of things, but not be interested in gambling. So it's not necessarily that they're compelled to by being in these settings, but it's the sociality of it again, being with their mates, talking about sport, watching it on the screens that are in the pub. These are the things that are influencing their decisions a lot of the time. And again, talking about the masculinity and the mateship of it, it's really something that has been normalised, as I said, throughout their lives. And so David here is talking about the way that when sort of he's choosing friends and making friends, having people who are going to take risks, chuck in $100 with him, get a cab to the nightclub. They're the types of people that he's been sort of more likely to be friends with because of the strength of those sort of bonding experiences, and also the opportunity for masculine shows of emotion, to be able to be excited with a group of blokes and to be able to sort of show some vulnerability when you haven't had a win or your money's gone out the door and you're not sure where it's going to come back from. And in relation to that, it's also been quite clear that a lot of these young men take it quite seriously in terms of looking out for their mates while they're having a gamble. So if someone is sort of going over the limit, so to speak, most of the participants talk about being comfortable with saying something to their friend and sort of just keeping an eye out and sort of wondering how they're doing if things are getting out of control. So I've covered most of this, I might skip through that. But at the same time as all this stuff, there are quite a number of positive experiences. So you've got the obvious ones of like winning money and the excitement and sort of exuberance that comes with that. But there's also been some interesting points that have been explained by the participants. So Lachlan here is explaining about in his community that he grew up with, he's the one participant that wasn't from Newcastle. It was a long tradition in his community around a particularly big horse race for the whole sort of family to get around and sort of put bets on with your grandmother. And it's sort of very much seen as something that creates that cohesion and connection amongst that community there. And he looked back on those memories very, very fondly. And David here is explaining the way that sort of being with friends and having those influences of gambling and the excitement, as I said, are really something that he sort of looks on positively that are facilitated by his gambling practices. As I said, we've also got the winning and the excitement that comes with that. And I will hand back over to Julia.
Yeah, so just to kind of sum up some of what we're thinking about and some of the directions that we think we might go in with this research, we clearly found that the sociality of gambling is really central to its appeal to young men, and that gambling is very much kind of tied to performances of masculinity, particularly this kind of white Australian cis heteronormative form of masculinity, and that these gambling practices are also incredibly tied to the consumption of and participation in sport. So there's kind of gambling taking place around and kind of during breaks and after sporting matches among teammates, and then while they're spectating sport as well. So sport is incredibly kind of central to the gambling practices, and also the role of alcohol is enormous and is very much within the mix. So we also found it quite interesting the kind of gambling socially seems in some ways to be kind of protective, perhaps. So any kind of experience where our participants mentioned, going too far, having a bad experience, it was pretty much exclusively when they were gambling alone. And when they were gambling with their friends, they generally didn't have that experience, whether it was their friends kind of actively looking out for each other, as Jonathan mentioned, or the desire to save face, something about engaging in that practice as a kind of social collective practice did seem to kind of prevent, particular kind of gambling related harms. And so we're quite interested in this tension between, obviously friends are kind of encouraging another conduit to young men's gambling in many ways, but they're also potentially kind of protective against some gambling related harms. So there's something kind of interesting and contradictory going on there that we'd like to unpack more. And then finally, looking at all of this and especially looking at the aspects of kind of mateship and like looking out for each other, preventing mates from going too far, my mind turns to care and some particular work in critical masculinity studies around the concept of caring masculinities. This concept's been drawn on primarily in work to looking at men and parenting and within relationships. And so I'm interested, can we think through this concept in relation to male friendship and to mateship in this particular context? So that's some of what's on the agenda for us. Thanks for listening.
Thank you. Yeah.
Thank you. It's a very interesting study. I have quite a few thoughts. Unfortunately, it's a topic I know more about than I want to. I'm interested in the fact that you're focusing on apps, and I'm curious because you're also noting that a lot of this is happening in the pubs and with mates. The sociology of gambling is definitely something that, you go to a pub and putting $20 down on the table, everybody puts $20 in, and that becomes a syndicate for the night. To what extent are you looking, and to what extent are your participants reflecting on the role of the tab? I'm also interested in whether or not you're looking into the issues of kind of syndicate, but also kind of how people, the idea of knowledge, of being able to know a pedigree, knowing how this is going to go. My experience of gambling is that it's money, but it's also status, because it's showing that you know the game, you can read the game. So I'd be interested to hear what you say about that. And it'd be interesting to hear what the boys say about their ladies.
Yeah. So on the first point with the preference for the app or our interest in the apps over the tab in the pubs and those sorts of things, that's primarily driven by the participants who specify that they, for the most part, exclusively use the apps. If they have cash in their pocket, they might, on a night out at a pub with a tab facility, might use it, but it seems to be sort of in line with the ideas around convenience and familiarity of opening your phone and sort of using it for financial practices seems to be really, really relevant in terms of how the participants are actually doing their gambling. And then in regards to your question about sort of status and knowledge and that sort of thing, it's been quite evident that most of the participants sort of don't see themselves as being particularly knowledgeable in any way. And that seems to be in opposition, like sort of in contrast to sort of older people that they might know from their sports clubs who sort of take them under their wing, so to speak, in a syndicate that's run through the sports club and show them how to bet. And there's one participant in particular who did describe himself as being knowledgeable, and he sort of had made significant time and financial investments in horse racing in Hong Kong. and was purchasing quite detailed form guides for specific races in the Hong Kong racing scene. And then his friends were coming to him for tips and advice about which horses to bet on. And he did talk about the way that he felt good with them coming to him for that advice, that they knew that he had that knowledge and that he was able to impart it to them.
I was curious about the gender things.
The partners, yeah. Sorry. So most of them talk about how their partners know that they gamble. And I think it's very important to note that these are very, very heteronormative sort of situations that we're talking about, where there's sort of an unspoken understanding and expectation, it seems, that these young men on a Saturday are going to go to the pub and drink beer and bet on sport. Some of the participants talk about how their partners will have a bet with them from time to time in certain situations, but it's definitely a very, very blokey sort of world that we're talking about here. Interestingly, one participant has a syndicate at their work with their colleagues that does include women, but then he sort of talked about how they're not particularly involved in the auxiliary stuff around it, like the banter in group messenger chats and these sorts of things. It's more just because they're in the workplace that they're part of it and will have a bet, but otherwise not so much.
I'll just add as well, one of the few participants who spoke about experiencing something really kind of negative from gambling, his negative experience was kind of spending more money than he would have intended to and not having money to go on a date with his partner. And so that was kind of the really harmful, embarrassing aspect of that. So I think that was an interesting way in which the partner kind of came into it as well.
Yeah, do you want to have one more quick question?
Thank you. Maybe my question sounds a bit ridiculous, but do you think if rather than the gambling, this activity was more than a physical activity like a sports, if they participate, pay in it, and the winner gets all the money, do you think that you get the same results? As this, I'm trying to understand whether these results are only work for gambling or work for other social activities too.
I'm not sure I could make a comment on that at this stage. Like, are you asking, could these points be, oh, sorry.
Yeah, sorry.
Are you asking if these points could be extrapolated beyond these sorts of gambling practices?
For example, if they don't use that money for the gambling and they use it, for example, they keep the $100 and they spend it to go on a vacation or anything else, would you even males would participate in that, or only they would participate in if it is gambling?
I'm not sure, to be honest. The money that they spend on the gambling is something that sort of in their ad hoc budgeting is something that they've put aside for that purpose. Mm-hmm. They're spending that, they know that they're not going to get it back generally, and it's just, okay, I'm going out on Saturday night with my friends, I'm going to spend $150 on bets, and that's it. And then if they make money from it, they might put that money towards taking their partner on a date or holiday or something like that. But it's not the sort of main goal of those practices. I'm not sure if that answers your question or not.
I'm just going to move on to ask one last question before we do this. This is from the chat. So Gavin Smith asks, says, great session, thank you. Were there different meanings and temporalities that were attendant on the different gambling infrastructures? So, yeah.
Yeah, that's a great question. I don't know if we have enough data to really answer that, just because we have focused on, I suppose, on this specific infrastructure, and we're looking quite narrowly at this one particular type of gambling. And I think the practices we've come across so far have been relatively homogenous. So I don't think we can see enough variation to talk about different temporalities.
Yeah, I'd agree with that totally.
Yeah, but I think that's maybe I suppose like temporalities of different apps, different types of sports gambling, sports betting. That is perhaps something we can think about. Did you?
Yeah, I can say something about it. I mean, the temporality is very next week. And in terms of relating to your question, like a lot of the data here shows that they don't really see gambling as a financial thing, it's a leisure practice. So that's an important thing to point out there, I think. The other thing I would say is that in terms of temporalities, particularly in sporting clubs, gambling is often used, I think it was mentioned in one of the quotes, as a kind of thing for the end of the year. So you'll chuck in $50 a week, you bank 25 of it, and then you bet the other 25. And so there's a kind of essence of something to look forward to, investing in the end of the season and all going out and getting on the piss and celebrating the end of the year, and you go to,
Doing more.
you go to Port Macquarie or you go to Brisbane, with the whole fantasy built in that if someone has a massive win, you go to Las Vegas, right?
Which the NRL is going to.
Yeah. So, but no one seriously thinks they're going to Las Vegas. But there's it's something we can all joke about in the cricket club or whatever. So, I think that there's multiple temporalities built into the weekly stuff, the more team-oriented stuff or club-oriented for the end of the year. But then for the individuals that are betting by themselves, sometimes that's a whole different kettle of fish that we haven't really done research on in this that much. Yeah.
And the temporality, sorry, I'm jumping into, and is very much tied in with the spatialities and the landscapes and the broader social settings that the gambling is occurring within as a multiple and very distributed aspect to it. Yeah, we need to move on now, but thank you very much. So, unfortunately, our final speaker, Professor Bev Skeggs from Lancaster University, has taken ill very recently in just the course of this evening. But Roger works very closely with Bev and has her slides, and I believe he's very generously going to work with them. And I don't know, I'll let you explain maybe what you'd like to do. Thanks, Roger.
Well, I'm no substitute for Bev Skeggs. If any of you know Bev Skeggs, I think she's probably the most impressive sociologist to come out of the UK in the last decade. But that's just a personal view. And a very generous and good person as well, which is a rare thing in British Academy at the moment. Bev unfortunately is unwell, but she has done some slides. So I know a little bit about what the slides contain. So we'll see how far we get. You might need to help me a little bit as well.
Sure.
But what Bev was going to do was she was going to reflect on a fantastic project that she did under an ESRC professorial fellowship a few years ago, which was rather than just take as read this notion that social media, Facebook in particular, was not just sucking up data, it was actually analysing it in real time. I don't know if you've had this experience, when you sometimes even say something or you look at something and suddenly an advert pops down in front of you. Well, we kind of couldn't observe that, but they were quite interested in trying to see if you could retrofit to try and sort of reverse engineer the process by which that happened. And the papers, most of which have come out in a journal called Information Communication Society, try and apply a kind of, and this is not what Bev normally does, but tries to apply a kind of a computational social science to reverse engineer, if you like, various interfaces to try and find out how this happens. But what she was going to do, because that project was about 10 years ago now, she was going to try and think how that plasticatory impulse, because it relates back to what I was talking about before, has become kind of normalised, I suppose, within many of our practices, and the way in which essentially the relationship between value and values is constructed. The way in which our tastes, our preferences, our sensibilities are increasingly kind of codified within social media. And as I said before, now mobilised, we live around the city with us as markers of our tastes and preferences. So that's what she was going to talk about today. So it was really, as she says, a reflection from a software research project on Facebook, exploring the organisation of value and values, designed to capture, based on designated algorithmic, spelled incorrectly there, Bev, note on the rhythms and evaluation. I won't try and read it because I'll show you some of the graphs. This was a project carried out with Simon Yule, who we hope to work with at some point as well, who's both a computer scientist and an artist and a sociologist, multi-talented guy, and one of the very few people in UK social science who've been taken on the project to try and, as I say, reverse engineer what Facebook was doing at the time. So it was really about this kind of rhythms of interaction, the way in which your various kind of moves around Facebook, your various clicks, your various kind of friends, networks, and such like, were all, in a sense, going immediately up into the cloud and machinically being clustered and then sold to for tiny cents worth, micro cents, to advertisers who would park an advert in front of you based upon those kind of sets of connections. And we all get a sense of this. And the point that she makes in the papers is that this isn't just within Facebook. If you had Facebook open, it was sucking up anything else that you had open. Your emails, the paper that you were refereeing, Instagram, a whole range of other things were all being sucked into this social media profile. Were being clustered in real time and were being sold back to you recursively within a matter of seconds, often in relation to your actions. So the power of classificatory tools becoming absolutely fundamental. And again, comes back to the thing, you didn't know what it was that you were doing that was leading to you being sent this advert. And so it's like this kind of real-time sort of recursivity that they go through. These are, she would have spoken in detail about the processes they went through to actually look at the way in which this was happening in real time. Here's some of the kind of the graphs and charts. This is from one of the ICS papers, the methodology of the multi-model project examining how Facebook infrastructure social relations. And so things that you care about, people that you care about, things that you're interested in become commodified. And if any of you have seen her presentation at the LSE, when she's talking about this, it's online, we can give you the link. You can see people have their laptops open, and after about 10-15 minutes of her showing various of this data, people are shutting their laptops down with a sudden realization about actually what's actually happening here. Especially, I think, and now of course you can stop this happening on the iPhone, the way in which different apps were tracked across your activity, the way in which Facebook in particular was functioning as this kind of data dredge that would come in and be utilized within itself in relation to the placement of adverts. So again, these are various kinds of analyses about the Facebook tracking of general browser use, as I was saying before, collecting all sites data, keyword matching, enabling profile building. And of course, this is before the ubiquity of ChatGPT and AI and such like. So the acceleration of these processes, I think, is interesting as well. And then I think what she does in the paper is to look at these kind of algorithmic representations of person wealth, who has value, who doesn't have value, who is targeted, who isn't targeted in relation to these machining processes. Again, I can't interpret the graphs, but she would have been able to explain what they were doing at various points in terms of these various processes. But it was this idea of assessing your potential based upon the very mundane things about who you were, what you were interested in, what your values were. And she's got examples of that. And again, it's in a sense echoing some of the things I was saying before, actually, although it's probably Bev has written more about this than I have, in terms of the anticipatory regimes of recognition based upon tastes and preferences, musical tastes, academic tastes, and so on. Things that we've become increasingly familiar with, but we haven't really understood the full consequences on. So then this was also about how you might begin to kind of resist some of this, and how you might begin to experiment with some of this, and the way in which they would play around with the interfaces to see if they could, because of the reverse engineering, actually get particular adverts to drop based upon particular movements and particular clicks that you would engage with. What have we got here? Don't know the paper by Brugger, so I can't really say anything about that. But the idea that everything can now be tracked, and there is value in your values, there is value in as Bev says in the LSE presentation, it's difficult to think now of anything that cannot be commodified. Poverty can be commodified. We can turn it into a TV series. Misery can be commodified. Debt can be, it's almost impossible to think outside of the kind of the international situationist dream of how you would kind of decommodify something. Now everything has a value, a speculative value in some way, shape or form. How can you begin to resist those processes? Because, quite clearly in the old sort of situationist take, the exchange values are undermined by use values. To use the old George phrase, the t-shirt revolt into style. Anything that even is radical or progressive or angry no longer has the same kind of political purchase, because it will become a t-shirt, it will become a meme, it will become ironicized, it will take on a value of various sorts. So how can we think of kind of a set of political practices that begin to resist that? So then she moves on in the paper to try and think about, after reflecting on 10 years, other things that have happened, and I think in particular the kind of the politics of the people who are engaged in these processes. And we should talk about this a little bit on Thursday evening, but it's not just Elon Musk that we need to be concerned with, it's also the politics of people like Peter Thiel and companies like Palantir and other people who are multi-billionaires who are engaging in this kind of technology, where we are the kind of the nodes, I suppose, in terms of value extraction points that perhaps possibly haven't fully understood. And then you've got some cross-national instances of the application of these things, and I'm sorry I can't kind of elaborate on that anymore. A book, again, can't say I've read all of the book, but The Weapons of Math Destruction by Cathy O'Neill. Which looks at the arc of a person's life in the US. And again, relates a little bit back to what I was saying before: primary school tests, education funding, teacher scores, college recruitment, job applications, CV scanning, evaluations, banking, credit, spending habits, anything that can be digitized, anything that can be used to kind of cluster and characterize and target within one's life course. And then some conclusions, I suppose, about privacy, poverty, and big data, and trying to generate a kind of a matrix of vulnerabilities for poor Americans, which comes out of the book. Automating inequality, I have read how to high-tech tools profile police and punish the poor. Same thematic, I guess. And now I think we're in note form towards the end. A failure of regulation, not even clear what we need to regulate, the speed of regulation compared to the kind of acceleration of the technologies that we can kind of grasp. Once we've got an analytic description of it, once it's gone through the process of academic publishing or policy profiling, it's disappeared and we're on to the next thing. So we can't really find a kind of a set of regulatory regimes that will keep pace. So, you can't be someone interested in global inequality or social inequality or class or gender or race without actually being a digital sociologist nowadays. In a sense, all of these things have become folded in and accelerated by these three processes, and they do have a particular politics. Okay, we're back to social credit, I guess, and perhaps our critique of the Chinese model might be a little bit more reflective in terms of the regimes under which we also live, in terms of the way in which those processes recursively lead to a variable person value, reproduction of the digital possessive individual. Not sure. And then she's got some examples of some excellent work by an Australian team who do research on young people debt and credit that she says worth having a look at, most of whom are in the room. So I'll probably leave it there. I'm sorry I haven't done a terribly good job on it. And Bev is one of these people who's fantastic at kind of riffing on a whole series of ideas and bringing things together in a way that is impressive and coherent. But conclude, and it's the same thematic again, to be a subject or to be subjected to these processes and to think strategically about the ontological power of classificatory regimes and the imputation of kind of value from our values, from who we are, what we want, who we think we are, what our tastes and preferences are, and what we can do about the way in which all of those registers turn into dollar signs, turn into differential patterns of inclusion and exclusion without us necessarily being aware that has happened. So it's very sorry that she couldn't be here, but they were the sorts of thematics that she was going to talk about. If you haven't read them, I'd certainly recommend those ICS papers on Facebook. You'll see social media in a very, very different way, and perhaps you have done it too.
Thanks, Rhonda, for very generously being able to present your yeah, a special kind of colleague who can do that. So thank you.
Can I just say something
Yeah.
very quickly? So I'd just like to say something very quickly on it as well. I mean, I've got 2 quick points. Firstly, as sociologists, I mean, this stuff fundamentally challenges all of our categories. You know, I'm very influenced by Pierre Bourdieu and distinction. You can see all this in there, but like the very idea that our tastes are our own is now challenged because these things are providing us stuff in real time, like in terms of what we consume and what we're brought to our attention. So our attention now is what's sold. That's almost a cliche, but our attention is no longer our own when we start thinking about these kind of things. Maybe to address the question earlier on about so what, I think the ethic here is very important to consider. To continue the bet with mates thing, I mean, if I'm in a sporting team with someone, I'll be categorised before that. If I go to the pub with them, I'll be categorised before that. If I have a bet with mates with them one week, I'll be categorised with those people. If a couple of those have foreclosed on a mortgage and I haven't, why should that affect my ability to access credit in the future? Under this model, it will. I'll be associated with people regardless of the fact if my behaviour actually matches it or not. Largely because this stuff is based on correlation, not causation. You know, a very commonly used scientific cliche, but like this is what these things do. They're correlation machines. So there's the kind of key ethic I think that we really need to consider about the way that platforms, data, algorithms are encroaching across many different aspects of life. None of us are really asking for it. The kind of instinctual reaction there for people that want to defend it is go, oh, you get a phone and you sign up and you click the box or whatever, and like, but these things are so embedded in our lives to get by now, you can't not use them. So there's a whole bunch of things here that need to be considered politically that we simply can't keep up with. I think that's the problem here is the rapid notion of social change that's happening around these things that it's very difficult to keep up with unless you kind of study it full time, and I still don't understand it. So they're the kind of things I would say more broadly, that's the things that sociologists that are kind of concerned with the inequalities and the ethics of this are concerned about, I suppose.
We had a question from the chat earlier that we didn't get to, so I'll ask that now on behalf of Milo, but please, if you have other questions, I'll come to you straight after. So Milo asked, I think this was in relation to your paper, Steve. Or maybe it was
No, it's Rogers.
Okay.
It's Rogers. Yep.
Do you envisage open banking and other social monitoring apparatus to be regulated in any way due to the overwhelming potential for privacy breaches and impacts on economic and social mobility? So related by government or the ACCC or similar?
You know, you would hope so, but open banking came out of a kind of a regulatory review in the first instance and has been actively encouraged by certainly the UK state and I guess by the Australian state as a way of improving people's kind of strategic conduct in terms of the management of their finances, I guess.
The government did
But the Australian government's overseeing the rollout here. So it's very much, the phone is ringing within the house.
But I think it will come almost inevitably. And, I don't know how you feel about it. Do you mind people seeing your current account activity and clustering your expenditure? Give you a higher or lower credit score based upon your expenditure? You don't have to fill in those nasty forms every time you want to rent a house or get a mortgage because they already know exactly what you've got in the bank. I don't know how people feel about it. I don't really, but I think it's coming and it has consequences. But I mean, a broader issue really is just in terms of the almost kind of utter inadequacy of governmental regulatory regimes. I mean, you saw it when ChatGPT was released. I mean, I haven't got a clue. I haven't got a clue about what to do or how to engage with it. I haven't got the expertise. And even if they have got the expertise, I don't think anybody really knows what to do with a, as Nigel Thrift would see it, as a new intelligent entity that is out there and living with us and is among us. I think we're, it does feel a little bit like a runaway world, and I'm not really sure what regulatory regimes are going to look like. Right.
Any other questions?
Hi, thank you for amazing talks. Like the synergies between everything was fantastic, and it's exciting to have, the Youth Studies Centre people presenting all together and your fantastic colleagues, like super energising. I had a question about the Betting with Mates project, and it's a really simple question, probably too simplistic, but there seems to be a gap between Australia is the worst gambling nation in the world and the young men are all right, like there's no problem here, keep walking along. So I was just wondering, how do you get at that? Or is it about who you've been interviewing so far? Or, what? And I'm not trying to demonise young men either, but it's like you'd kind of expect I don't have a problem as a response. But anyway, just so curious.
Yeah, thank you so much for that question. I suppose the kind of potential for gambling related harms was really at the centre of the conception of this project. And when we began this project, we had a really interesting meeting with Gamble Aware, the Newcastle branch, some people there, and we know from them, as well as a wealth of literature, that men, particularly young men, are not very good at help seeking and at admitting that something's wrong. So, there is a complete possibility that, I don't really get the feeling this is the case, but it is possible that the young men we've interviewed so far are actually experiencing some significant harms and are not being honest with us about them. That is always possible. We have not gone through their bank accounts, unlike some of these algorithms. Yeah, not yet. So look, that is possible. I don't think that's necessarily the case, but I think in terms of what our project can do, or the direction we take that in with this all in mind, and with the idea that gambling is not necessarily always a fantastic practice. I think our focus is really on, I guess, like harm minimization, or how gambling practices can be managed, because looking at how early these practices are starting and how embedded they are in people's kind of social lives, their practices, how they spend time with their family and their friends. I think there's so many parallels with alcohol. Just saying no more alcohol for anyone or no more gambling for anyone is not necessarily going to be successful. So I think what we're left with there is harm minimization. And I think there's a really interesting space in these peer groups. I think it's fascinating that there's this kind of moderating influence that men have on each other, and that they're looking out for each other. So my mind's kind of going to some kind of, mind your mates, like education campaign, or, something like that, some kind of peer education or like peer mentoring. I think that would be, if we had to turn this into something of that nature. That's where my thinking is kind of going with this. But yes, we're very much alive to the fact that, you know, this is so normalised, and we know that there's huge amounts of kind of gambling related harm out there, and you know, those things exist in the same universe.
Yeah, and sorry, to add to that, trying to understand it as a social practice as it's happening, as it's very rarely just sort of one thing that's being done. It's happening in a very specific, gendered, social environment, and the socialities of you know, community sport and the infrastructures and institutions that it occurs within are as important, I think, as just the app itself, for understanding that much broader environment which it happens in. And we're certainly not, we're wanting to understand and certainly be alive to the potential wellbeing impacts that relate to gambling, which can be, of course, very significant, and related to the hugely problematic and difficult harms related to indebtedness as a real social harm more broadly. But yeah, trying to understand the landscape of debt practices, and particularly the social and cultural landscape that those practices occur in.
Yeah. Thank you. I just had a tiny quick follow-up, because it was really interesting that the betting with mates is good mates, but with the girls, sending someone an invitation to buy now, pay later is not a good friend. You know, so that's a really interesting kind of gender dynamic to emerge from that.
Yeah, it's a really good pickup. Yeah, it's a good point. Thanks. Heather, you had another question?
I guess follow up on that. I'm just wondering, since it's still early on in the study, have you contemplating your sample and what it means to have recruited through sporting clubs? I can't say I know any of this, but I wonder if you would find other behaviours if you recruited through other social settings. My experience of care in this setting certainly isn't reflected in the data that you've gathered. That was just something I wondered if you would consider. And another thing, just I guess to remember this, I think you struggle to get a gambler to call himself a gambler.
Yeah, we struggled to get participants in the BET project originally because people often don't want to associate with those stigmatised practices or behaviours, and that's one of the reasons we targeted this as a recruitment strategy, as a pilot. So, yeah.
Yeah, so the gambling thing's really exploratory because a few things are not related back to the other one. Is like all the gambling research is about harm and problems. Most men that do have a gamble every now and then don't have a problem. But the research about it is from that point of view, and therefore it kind of excludes all the sociality around it, all the different bits and pieces that we think are important about why people do it in the first place. So there's definitely that. The reason we targeted sporting clubs and why we're targeting men in this is for a couple of interrelated reasons to do with methodology and previous studies. So in the debt research, we found it impossible to get men to come and talk to us about being in debt. No one wanted, no men. Women would, not so much men. So this was a way to get to talk to young men about their finances more generally. So that was one aspect of that kind of recruitment. The other thing is that it was very much, of course, it's such a smallly funded thing where we don't have a lot of money to kind of recruit. It was very much convenient sampling done through my contacts of 30 years of sporting stuff in Newcastle. But also with the immense amount of money that, like, you watch any game of football, there's just like 25 ads per second on this kind of stuff. So the way that it's become embedded in the normalisation of sport. I was running a cricket club for 20 years up until a couple of years ago. The 15-year-old kids would come into the club like pissed off that they can't bet on the cricket, right? Because it's on they've seen the ads, they've learned about it, they want to do it. So I'm really intrigued in that aspect of how that happens. The other irony is, of course, is that all local sport is founded on gambling establishments. So the club I played for was massively $100,000s of dollars a year that they make out of gambling. They whack us 20 grand a year to keep our cricket club going. So there's this kind of self-fulfilling prophecy that happens within that, both with gambling and alcohol consumption, both of which I'm interested in how that all kind of connects together and what we can see about that from a kind of broader sociological lens. But definitely the main motivation was to actually talk to some young men about their financial practices. Yeah.
we are almost out of time. We have time for one last question if someone would like to say something or ask. Otherwise, I'll wrap it up and say thank you so much for being here. We really appreciate it. And thank you to all our speakers. And thanks to everyone online for joining us as well. It's great to have you. And yeah, I hope you can make it to other social science events. So we have Roger Burrow's public lecture tomorrow night at 5 o'clock in this building.
Yeah, it should be in the big room downstairs. Yeah. X101.
X101. And Heather is also hosting an ethnographic film night on Friday night as well. So those events are all linked online. Please come along. We'd love to see you again. Thank you.